Dear students, welcome again. We were discussing the part 11, that is the techniques for the controlling, and in this particular part we are understanding the different ways of how the controlling things can be managed. In the part 11, in this particular module, we will be discussing the lecture 53, and in this lecture we will be understanding the detailed concept about what is balanced scorecard and integrated ratio analysis. But before that, let us try to relate the things we have studied in the earlier part and what are the things that we are going to study can be more helpful in understanding the concept. We have seen in the part 10 is about the controlling. Now what is controlling? Controlling is like checking the performance of the subordinates so that they can be able to meet the standard ones and comparing the standard activity with the actual performances and taking the corrective actions. This is the controlling part. However, what we have seen in the controlling measures that it is something which the employee tend to resist. If the controlling mechanism is not fully developed, it means the controlling measure is not effectively it is implemented. It may lead to the higher resistance of the individuals. Ultimately, the employee or the subordinate, they will be not achieving their efficiency, and that will leading towards the company are not able to meet out the standardized version of the objective. So, what should be the effective way to implement the controlling measures? In this particular part 11, we are learning the different techniques that could be very much helpful in applying or implementing the controlling measures or the controlling methods. And in this part so far, we have seen in the module 51 and 52, we talked about the budgeting. Very first technique that we have understood is the budgeting. Now what is budgeting? Budgeting is a financial statement which depicts what should be the future estimation of the cost and how the standard activity that can be achieved, and what is the purpose, that reaching the higher efficiency. Alright. So, it is very important that we should be understanding each and every element of the controlling techniques. In the last session, we have discussed the budgeting as a method, what are the different types of the budget, the sales budget, the fixed budget, flexible budget, your labor budget, raw material budget, capital expenditure budget, different types of the budget we have discussed, along with what are the advantages of budgetary control and the limitation part as well. Okay. Now, in this particular module, we will be understanding the next type of your controlling technique is the balanced scorecard and integrated ratio analysis. But before that, let me give you an overview of what this particular controlling technique, what are the different things that we will be learning. So, what I have done, the controlling techniques can be divided into two major parts. One is your traditional controlling technique and modern controlling technique. As you can see, the traditional controlling technique comprise of your personal observations, statistical report, break-even analysis and the budget. So, the thing we have learned just now, the budgeting part, is a part of your traditional controlling technique. Now we are moving towards the new controlling technique, that is your modern controlling technique. And there are so many things to learn in the modern controlling technique. Very first one is your balanced scorecard, integrated ratio analysis, zero based budgeting, economic and financial measures, total shareholders returns, PERT and CPM, and lastly management information systems. There are other methods as well, like responsibility accounting, human resource accounting, but majorly these types of the modern techniques are like practiced by the managers to have efficient controlling applications. Now discussing with the very first one is the personal observation. Okay. Now what is personal observation? If the operation of a company is not so big, it means the department is like restricting or manufacturing, like the production department is manufacturing only limited number of the product. Okay. The operation is very less, or the coverage or the market base for the company is not too much wide. In that situation, the company or the manager or the subordinate will be visiting to the like different subordinate, different employees or the different workers, and personally they will be checking if the things are under the control or not. If any kind of problem or any kind of situation occurs, those situations can be tackled immediately by the supervisor. Alright. So, personal observation method is the simplest form of the controlling technique, where like systematic things are not happened, but the manager or the superior, they will be visiting the different premises, and they will be observing whether the things are going well or not, whether the employees are working as per the planned activity or not. In this way they are controlling the overall operation. Second one is the statistical report. Now the second part is with respect to some kind of data to be collected. Data in terms of like the sales report, in terms of any kind of equipments which has been damaged, any other data like how many employees are leaving the organizations. Okay. So these factors will be influencing the operation or the performance of the organization. So ultimately statistical report is like using some of the methods like regression analysis, your graph analysis, some chi-square analysis, mean median mode analysis. So this will give you a picture that whether the planned activity is going as per the standard fixed at the initial stage or not. Alright. So second traditional technique is also important. Third one is the break-even analysis. Now the break-even analysis is very important concept, and in this particular analysis it is like the manager is fixing that total cost or total revenue or the total sales should be able to cover up your total cost. There is a point when these two costs intersect, like total cost and total revenue intersect, that particular point is termed as your break-even point. As you can see in this graph, like this is your total cost and this is your total sales. This is the total fixed cost, sales line, total revenue. It could be your total fixed cost, and this is your total variable cost. Okay. Suppose this is your total variable cost, this is your total fixed cost, and this is your total revenue. Now the point where this line will be intersecting each other, it is termed as your break-even point. Okay. So again, like when the point at which the total revenue intersect with the total cost, or we can say the total sales which can cover up the total cost. Any line above that BP or the break even point is your profit. Alright. So with this the manager can also control the activity of the different subordinates. So, we talked about the traditional technique. Now, let us quickly understand or move towards the modern technique method. And in the modern technique method, the very first thing is your balance scorecard. Now, what is balance scorecard? What are things or what are the things that the company will be managing or balancing and like giving a proper score? This particular concept was emerged in 1992, and Robert Kaplan and David Norton have introduced this concept of the balance scorecard, or it is also termed as the stakeholder approach. Okay. Second is provide a comprehensive view by identifying and linking both financial and non-financial performance measures. Now, conceptually try to understand what is balance scorecard. Any company is made up of some shareholders, like the equity owner or equity shareholders, they are the owner of the organization because they have the voting rights. Okay. Or any stakeholder, be it like investors or any bankers or any suppliers, they are the stakeholders. Now, the balance scorecard emphasizes that how the activity of the company, operation of the company is making sure that the shareholders' funds are increasing or not, or better try to understand as shareholders itself. Suppose you are you have purchased a share of Tata Motors. Okay. Now, the point is what you expect when you are purchasing the share of the Tata Motors, that the company should grow, the company will be paying you the dividend on a regular basis. Alright, it is the point. As a like investor or the shareholder, these are your expectations. Now, these expectations can be categorized, or these overall the performance of the company can be categorized under the 4 different heads under the balance scorecard. Before that, let us try to understand financial performance indicate if the company's strategies and operation are adding value to the shareholders fund or not. So, what the company's strategies are and what the company's overall operation, whether these things are adding up the shareholders funds or not. If these things are not good, strategies and the overall operation, it will also impact the shareholders funds as well. If Tata Motors is not taking good decisions, what will happen? Their market share will go down, and ultimately you will be losing out your money because you have purchased the shares. They will not be paying the dividend because they are not running at the profit. Okay. So, overall shareholders perspective are taken into the consideration, and that is why it is called shareholders approach. Is it clear? Next, qualitative and quantitative measures, both factors are taken into the consideration. Not just we will be looking into the profit or the sales part, but the totality of the perspective, it will be more important for the like the shareholders or for the company. So, what are those 4 factors we will be understanding in details? Very first one, as you can see in the slide, is the financial perspective, customer perspective, internal business and production process perspective, and learning innovative perspective. And all these will be related to the vision and strategy of the organization. Very first one is the financial perspective. Now, financial perspective is with respect to the growth, success and the survival of the organization itself. If the financial position of the company, financial performance of the company is not so good, what will happen? The survival of the company will be questioned. We have seen too many companies which are running at losses. What is the reason behind it? Because the financial position was not so good. The overall debt was so high that the company were not able to sustain. Okay. So, financial perspective, other factors are like return on capital, cash flow, revenue growth, cost reduction, profitability. These factors will be like explaining the financial position of the company. Cost of or the return on capital, it means how much you have invested and how much you are getting out of it. If you have invested suppose 10 lakhs, so what is your expected rate of return? It could be like 7%, 9%. Okay. So, it is the rate of return on capital. Cash flow, whether the cash flow is like continuous cash flow is there or not. Revenue growth, it explain the continuous growth of the sales. Cost reduction over a period of time, whether the company strategies are like reducing the cost or not, alright, and ultimately the profitability. Second element talks about the customer's perspective, market share, transaction cost, customer loyalty, customer satisfaction, supplier relationship, defect per shipment or delivery time. These factors are very much important. Now, for whom you are like manufacturing the product, who are the most important element for the businesses? It is the customer, because you will not be selling your product to your employees. It will be the customers who will be purchasing your product or the services. So, it is very important that you should be like leading the market share. Okay. Transaction cost should be reduced, customer loyalty should be increased. Okay. Like your product should have the capability or the quality that the customer will be like repurchasing your product. That signifies the customers are loyal. Alright. Satisfaction of the customers. If the customer satisfaction is not there, ultimately they will not be loyal and they will be switching towards other competitors. Okay. Supplier relationship is also one of the important element. If you are not paying or making the payment to the supplier on time, the supplier may not be giving you the raw material. Alright. Defect per shipment, it should be the minimum like 2% to 3% is the maximum that the company are allowing. Defect per shipment, out of 100 total product you manufactured, it is possible that 2 or 3 products are defective or they are not properly functioning. On time delivery, you promised your client regarding the delivery date and you failed to deliver the product on the time. Okay. So, it will harm your goodwill in the eyes of your customer. That is why customer perspective is also very important. Other could be the internal business and production process perspective, like what technology on which you are working. Efficiency, it means how efficiently you are using the raw material, converting the raw material into the various goods and services. Okay. Life cycle time, it is like how much your product is visible in the market, how much time it is taking for the product to reach from the introduction stage to the growth stage. Alright. So, these factors are very much important. Defect rates, on time delivery to the customers and the supplier relation. So, these things we have already discussed. And the last matrix of the balance scorecard is your innovative perspective. If the company is like, if the entrepreneurs or the managers are having the creative ideas or not. We have seen many companies like at one point of time you have seen the Nokia. Nokia was leading the market and no one was there in the market to like ever come nearby. Okay. But what happened over a period of time? They were very much rigid toward their own technology. they were not so adaptive to the change technology, like having the Android system in their smartphones. Instead, they have their own software, Windows operating system. What happened? Ultimately, the customers like not purchasing the Nokia smartphone. Okay. So, innovativeness and adding new product is the like the solution or the mantra for your continuous development. If you are not doing or generating new ideas or taking suggestions from the employees, all right, it will be very difficult to retain the customers and enhance the customer satisfaction. So, overall what we have seen in the balance scorecard is representing the way in which you are making sure that the strategies or the operation is so efficient that it is adding up the shareholders profit, or you are considering the shareholders perspective on that. Okay. So, how these element your operation and the strategies can be like excelled. 4 parameters has been suggested by Kaplan and Norton in 1992. It is with respect to your financial aspect, your customer aspect, your internal production process aspect, and last one is your continuous innovative perspective. So, these factors should be taken into consideration whenever you are applying the controlling measures. Now, come back to your topic, what we are studying, the controlling technique. So, how the manager will be controlling using the balance scorecard? By emphasizing on these 4 factors, whether these 4 factors are properly it is done or not. If it is not, the managers or the superior need to relook the activity again. All right. Next, what are the advantages of the balance scorecard? Balance scorecard provide a comprehensive framework for translating strategies objective in measurable parameters that we have discussed. Like a balance scorecard will give you an idea, like we talked about the strategies, the operation part, but what it actually leading to. If your strategies are very good, but it is not like reflecting into the financial performances, there is no point of that particular strategy. So, balance scorecard is giving you the picture of the 4 like matrix that we have discussed. Second is better alignment of strategies and operation. All those strategies, like suppose the strategy that you have prepared or the objective of the company is to like increase the sales by 30% in the next quarter. All right. So, based on that you will be using the strategies, and the operation will be, or we can like debrief. Operation means the day-to-day activities will be related to those activities or those strategies. All right. So, there will be proper alignment of your strategies and the objective, because you have a clear understanding of 4 dimensions, that is your financial, customers, internal and your innovativeness. All right. Improve internal and external communication. The more you are oriented towards these metrics, it will be only possible when all the levels or the channels of the element of your workforce will be communicating. All right. Next is translating of strategies into the measurable parameters. Continuous measurement and evaluation against the standards. So, how the controlling things will be done? When you will be preparing the standards, you will be controlling when you will be like making a comparison and ultimately taking the key decisions. Feedback, it may be like the feedback is you are getting from the like lower level employee or the subordinate level. Okay, that we call it as a like intrapreneurship. Entrepreneurship is a concept where the employee within the organization provided new ideas. And so, new ideas we have discussed is the learning and innovative perspective. Now, second part or the second method of your controlling technique that we are going to study in this module is the integrated ratio analysis. Now, what is integrated ratio analysis? Before that, what is integrated? Integration, it has like derived from the word integration. Integration means like combining the things, combining the ratios. If you have studied the ratio analysis, the different ratio we are studying to measure the performance of the company, it could be your profitability ratio, liquidity ratio, solvency ratio. I am not going to explain what these ratios are. The point is, integrated ratio analysis like integrating all the ratios together and like take a singular ratio factor to measure the performance of the company. That is your integrated ratio analysis. Accounting ratio analysis is used to judge the financial performance of the company that we have discussed. What is the purpose of the ratio analysis? To like see whether the performance of the company is going as per the set direction or not. Alright, if your debt equity ratio is higher, it means you are taking too much of fund from the debentures, which is not good for the company. If your liquidity ratio is not optimum, it means you do not have sufficient cash to meet out your like current liabilities, and so many parameters are there. What does it signify? It tells you the story of the company performances. So, integrated ratio analysis, various ratios are integrated to judge overall performances. Okay. So, combining the different ratios together to judge the performance of the company. Alright. So, how it will be done? It will be based on the return on investment. It is a technique of the ratio integrated ratio analysis. So, we will be focusing our understanding on what is your ratio integrated ratio analysis and what is return on investment. It is very simple concept, return on investment. It means how much capital you have infused or how much capital you have used for any particular project. That tell you the story of return on investment. Okay. So, return on capital employed will be understanding with a hypothetical example. Profit is not taken as an absolute figure. Profit is an important aspect, but ultimately the ROI is the most important part. How much you are earning from a particular project where you have invested major proportion of your capital. Okay. ROI is the net profit by total investment. Okay. So, it is good for some investors that if the ROI or the profit of the company is continuously increasing. So, what you will be doing? You will be investing your like saved money to that company, right, because it shows the performance of the companies. Higher ROI reflect higher performances. Now, let us try to understand with an example. Suppose there is a company called Uber, we all know it, Ola and Uber. Now, the Ola or the Uber, they want to like introduce the cab services in an area where there is no like cab services, online cab services. Okay. So, they will be like making the project and ensuring that how much return they will be earning from that particular project. So, they have invested suppose 2 crores of the rupees. So, this is the total capital employed that we are discussing. Now, based on the different routes, they will be like taking the decision, this is the route 1, this is the route 2 and this is the route 3. Now, they will be making sure that which route should be selected. It is based on the return on investment. Suppose in the route 1 they are getting the return on 11%, route 2 it is 11.5%, whereas route 3 it is only 9% because of any factor. So, return on investment of route 2 is higher. So, Ola or Uber, any cab services, they will be selecting the route 2. So, this is the importance of understanding the return on investment rather than like using all your ratio analysis. So, quickly let us try to understand the advantages and disadvantages. The focus is on the profit. Obviously, it talks about the net profit divided by the total investment. Rational allocation of the resources. As you can see, 3 projects were there which you have selected the second one. So, ultimately you are using the best resources. Decentralization of authority, it means all your employees will be there who will be taking the small decisions. The decision power is not restricted to the upper level. And comparison, you have compared 3 routes, this is the comparison. Limitation is too much emphasis on the financial factors, non-financial factors are ignored, okay, like qualitative factor, the motivation level of the employees and all. Complex calculation, it is a little bit complex or too much lengthy process. Difficult in identifying the uniform rate for the comparison. It may be route 1, the parameters or the dimensions are different and because of which 11% is there. And for route 3 the same goes, like the 9% is because of some other factors. So, we cannot rely on the ROI part only, other factors need to be considered. And discourage risk taking. You are taking the route 2, okay, because it shows only higher ROI, but it could be the 9% ROI or the route 3, you will see there is more growth opportunities. Okay. So, with this we have understand the module 53, and in this module 53 we talked about the different types of the controlling techniques, the traditional and the modern, and in the modern we have covered up the balanced scorecard and your integrated ratio analysis. And I am leaving you with the suggested books that you can go through it, and in the upcoming module we will be discussing about the economic and financial measures. That is all for this session. Thank you so much.